Welcome back again, guys. So we will start with the third example or third theorem of Dow theory. A trend is the basic pattern of all prices. A trend can be upward, downward, or sideways. Obviously, a sideways trend is more difficult to profit and from than a upward or downward trend. Technical analysts endeavor to forecast the direction of the market trend. Dow theory posited that there are three basic trends in the price motion, each defined by time. As figure 2.2 shows graphically how these three trends are interrelated, let us look at each of these types of trend, the primary, secondary, and minor, a bit more closely. The primary trend is the longest of the three trend types. It represents the overall broad long-term movement of security prices. The duration of this long-term trend can be several years. The primary trend may be an upward trend, which is known as a primary bull trend, or it may be a downtrend, which is also known as downward trend. Referred to as the primary bear trend, the generally long-run upward trend during the 1990s is shown in the figure 2.2 here. Primary bull markets are characterized by three separate phases. The first represents reviving confidence from the prior primary bear market. The second represents the response to increased corporate earnings. And the third is when speculations become dominant and price rises on hopes or expectations. Primary bear markets are long and downward price movements interrupted by occasional rallies that continue until prices have discounted. Mostly discounted is used for stock markets and for forex markets also. They too are characterized by three separate phases. First, abandonment of hopes upon which stocks were purchased. Second, selling due to decreased earnings. And third, distress selling, regardless of value, by those who believe that the worst is yet to come. So we will study the secondary trend. A secondary trend reaction is considered to be an important decline in a bull market or advance in a bear market, usually lasting from 3 weeks to as many months, during which intervals the price movement generally retraces from 33% to 66%. The primary price changes since the termination of the last preceding secondary reaction, stated in Ria's book we have mentioned above. Then comes the minor trend. Inferences drawn from one day's movement of the averages are almost certain to be misleading and are of but little value except when lines are being formed, as we can see in here. See this caterpillar like structure? Yes, that's the minor trend when we zoom out the chart. The portion of Dow theories which pertains to lines has proved to be so dependable as almost to deserve the designation of axiom instead of theorem. In next chapter we will study water conformations. Thank you.